Welcome to Geo Remore. I'm Robert Johnson, your friendly host. We cover everything from world affairs to breaking news and global conflicts. The views in this podcast are only of the speakers. They don't always represent the opinions of Geo Rumor or its affiliates. We want to keep things honest and transparent. Thanks for tuning in. Taxes in America can be complex. They involve many levels of government: federal, state, and local. Here's an overview of how taxes work. Federal taxes. These are taxes paid to the U.S. federal government. The main types of federal taxes include income tax. This is a tax on personal and business income. The rate is progressive. It rises as the income of an individual or a business rises. For individuals, the U.S. tax system for individuals has brackets and rates. They go up as income goes up. Here are some specific tax brackets. As of the latest tax year, 7 federal tax brackets range from 10% to 37%. The bracket into which an individual falls depends on their taxable income and filing status. For example, single, married, filing jointly, etc. Standard deduction. Most taxpayers can reduce their taxable income using the standard deduction. Taxpayers can deduct a set amount from their income before the IRS calculates taxes. The amount varies depending on your filing status and adjusts annually for inflation. Itemized deduction. Taxpayers can choose to itemize deductions if the total exceeds the standard deduction. These include mortgage interest, state and local taxes, and medical expenses. They must exceed a certain threshold. You can also deduct charitable contributions. Tax credits. These benefits directly reduce the amount of tax owed. They can be refundable or non-refundable. Examples include the Earned Income Tax Credit, Child Tax Credit, and Education Credits. The last of these is the American Opportunity Tax Credit for businesses, corporations. For corporations, the federal income tax situation is different. Flat corporate rate. As of 2021, the corporate income tax rate is a flat 21%. It decreased from a high of 35%. The Tax Cuts and Jobs Act of 2017 did this. It aimed to make the U.S. corporate tax system more competitive globally. Deductions and credits. Corporations can deduct business expenses, include salaries, supplies, and depreciation. They can also deduct other costs of running a business. They also have access to various business tax credits that can reduce their tax burden, filing, and adjustments. Both individuals and corporations must file annual tax returns with the IRS. Filing deadlines. Individuals usually must file returns by April 15th each year. For corporations, the deadline varies by their fiscal year end. Adjustments for inflation. The IRS adjusts many figures for inflation each year. These include tax brackets, standard deductions, and phase-outs for certain credits and deductions. Planning and compliance. Tax planning is crucial for both people and businesses. It reduces their tax liability legally. This involves strategic use of deductions and credits. Taxpayers need to stay informed about changes in tax law. This helps them make the best use of available deductions and credits. Tax advisors and software. Many people and businesses rely on tax advisors or software. They use them to navigate complex tax rules, follow them, and improve their tax situations. Payroll taxes. Employer deducts these taxes from the employee's paycheck. They fund Social Security and Medicare. Social Security taxes are part of the FICA, Federal Insurance Contributions Act. They fund the Social Security program. It provides retirement, disability, and survivor benefits to workers and their families. For more details. Tax rate. The employer and the employee contribute 6.2% of the employee's earnings. This applies to earnings up to the wage-based limit. Annually, they adjust the limit for inflation. For example, in 2023, this limit is $160,200. Wage-based limit. This is the maximum amount of earned income the tax applies. Earnings above this limit are not subject to Social Security taxes. Medicare taxes. Medicare taxes fund the Medicare program. It mainly provides health insurance for Americans age 65 and older. It also covers some younger people with disabilities. These disabilities are as defined by the Social Security Administration. Details include tax rate. The standard Medicare tax rate is 1.45%. It applies to all earnings without a cap and is the same for employers and employees. Additional Medicare tax. High-income earners must pay an extra Medicare tax of 0.9%. It applies to individual incomes over $200,000 or $250,000 for married. Collection and compliance. Withholding and payment. Employers must withhold these taxes from their employees' wages. They must then pay the taxes and their contribution. They report these taxes using IRS Form 941. It is the employer's quarterly federal tax return. Self-employment. Self-employed people pay the employer and employee portions of FICA taxes. The Self-Employment Contributions Act, SECA, taxes refer to these taxes. They use Schedule SE to report their earnings. They use it to calculate their payroll tax when filing on taxpayers' benefits. Paying Social Security and Medicare taxes gives workers credit. This credit goes toward their future eligibility for benefits from these programs. The number of credits for eligibility depends on the type of benefit, but it usually takes 10 years of work to qualify for Social Security. No withholding cap for Medicare. Unlike Social Security taxes, there is no upper income limit for Medicare taxes. All wages face Medicare taxes, which ensures that higher earners pay more. Importance of compliance penalties. Employers who fail to withhold or pay FICA taxes may face heavy fines and interest. Employers must comply with these taxes, and avoiding penalties is crucial. Annual reconciliation. At year's end, employers must match their tax filings with the actual taxes withheld and paid. Form W-2 details the amount of taxes withheld from each employee's wages. Corporate taxes. Taxes on the profits of corporations. 1. Flat corporate tax rate. Before 2018, the U.S. had a graduated corporate tax rate. The rate increased within. However, the 2017 reform simplified this into a flat tax rate. 21% flat rate. All C corporations now pay a flat tax rate of 21%. The change was intended to make the U.S. more competitive. It did so by lowering the corporate tax burden, which was once among the highest in developed nations. 2. Deductions for businesses. Corporations can cut their taxable income with deduction. These are expenses needed and normal for business. Some of the key deductions include cost of goods sold. COGS is the cost of items sold during the year. It can include the cost of making or buying them. Business expenses. Ordinary and necessary expenses incurred in running a business are deducted. This includes rent, utilities, salaries, and benefits for employees. Depreciation allows businesses to deduct the cost of items over their useful life. It recognizes the wear and tear on machinery, buildings, and vehicles. Interest on business loans is usually deductible. This reduces the cost of borrowing for businesses. 3. Tax credits and incentives. Corporations can benefit from deductions. They can also get various tax credits. Credits directly cut the tax owed rather than just income. Some common credits include research and development, or in tax credit. The design encourages companies to invest in U.S. innovation. You can get credit for expenses to develop new products or processes. Energy credits. Businesses can get credits if they invest in renewable energy projects. They can also get them to make energy-efficient improvements to their facilities. Work opportunity tax credit, WOTC. Employers get this credit. They get it for hiring people from certain groups. These groups have long faced big barriers to employment. 4. International considerations. The 2017 tax reform also included rules for the foreign operations of U.S. corporations. Global intangible low-taxed income. GILTI. The U.S. taxes corporations on income they earn from their foreign subsidiaries. This aims to stop them from shifting profits to low-tax countries. Foreign-derived intangible income, FDII. This provision offers a lower tax rate on some income from foreign sources. It aims to encourage companies to keep and create intellectual property in the U.S. 5. Compliance and reporting. Corporations must file their federal taxes annually using Form 11 to 20. Keeping accurate records and understanding tax rules is crucial. The IRS closely checks corporate tax returns. 6. Impact of flat rate. The flat rate simplifies tax planning for corporations, but it also removes the progressive aspect of the tax system. In it, larger, more profitable companies pay a higher rate. The flat rate aims to be fair to all corporations, but it has led to debates about its impact on income inequality and government. Excise taxes. Taxes on specific goods like gasoline, alcohol, and tobacco. 1. Types of excise taxes. 2 main ways exist for levying excise taxes. Ad valorem excise taxes. These are percentage-based taxes imposed on the product's value. For example, a tax could be a certain percentage of the retail price. Active sentence. Specific excise taxes charge a fee per unit, such as per gallon, per pack, or per item. This method is common for alcohol, tobacco, and fuel. 2. Commonly taxed products. Gasoline. Federal excise tax on gasoline helps fund highway and transportation projects. In recent years, it has typically been around $0.184 per gallon. Alcohol. Taxes vary by the type of alcohol. Beer, wine, or spirits. They also vary by their volume and sometimes their alcohol content. For instance, spirits generally face higher excise taxes than beer and wine. Tobacco. Taxes on cigarettes and other tobacco products are high. They aim to discourage smoking and to pay for health costs from tobacco. The federal excise tax on cigarettes is $1.01 per pack. Firearms. Federal excise taxes on firearms and ammunition help fund wildlife conservation efforts. The tax rate is 10% or 11% of the sales price, depending on the type of firearm. 3. Activities subject to excise taxes. Wagering. Gambling is subject to excise taxes. The taxes apply to wagering and the business of taking wagers. Heavy trucks and highway use. Owners of trucks with a taxable gross weight of 55,000 pounds or more must pay a federal excise tax. The tax funds highway maintenance and construction. 4. Impact and justification revenue generation. Excise taxes are a significant source of revenue. They're easier to collect from a few producers and importers, or to collect them from the public. Behavior modification. Taxes aim to reduce harmful behaviors by making certain products more expensive. Increased tobacco taxes reduce smoking rates. Cost recovery. The taxes fund infrastructure. The users benefit from it. The taxes align costs with usage. 5. Implementation and collection inclusions. Excise taxes are usually included in the price of the product consumers. For instance, the gasoline pump price includes federal and state excise taxes. Payment to government. They usually pay excise taxes to the government, which they then pass on to consumers through higher prices. 6. Administrative aspects. Filing and reporting. Those who collect excise taxes must file federal forms. They must file them with the IRS. The reporting helps ensure compliance and proper revenue collection. Taxes. Each state in the U.S. has its tax system and can levy various types of taxes, including state income tax. Not all states have this, and those that do may have different rates and brackets. 1. Varied existence and rates. Income taxes show considerable variation across the U.S., both in terms of presence and rate structures. Tax states. States do not impose a state income tax. Alaska, Florida, Nevada, South Dakota, Tennessee, Texas, Washington, and Wyoming. Most recently, New Hampshire joined. It only taxes interest and dividends. High-tax states. At the other end of the spectrum, states like California and New York have high-income tax. Example, California's top marginal tax rate is one of the highest in the nation. This variability can influence individual and business decisions. It can affect where to live and operate, impacting job markets, housing prices, and the economy in a state. 2. Progressive versus flat rates. The method of calculating income tax also varies by state. Progressive tax systems. States like California, New York, and Minnesota have progressive tax systems. Tax rate rises as income rises. These systems aim to ensure fairness. They tax higher incomes at higher rates. Flat tax systems. In contrast, some states like Illinois and Pennsylvania use a flat tax rate. The same percentage rate taxes all taxable income, regardless of the amount earned. This simplicity can make tax compliance easier. Critics often criticize it for providing less fairness to lower income earners. 3. Deductions and credits. State income tax systems offer many deductions and credits. They are like the federal tax system. These can cut the tax you owe. Standard and itemized deductions. States may allow standard or itemized deductions, which are similar to federal deductions. These can be for mortgage interest, state taxes, or charitable contributions. Some states require conformity to federal itemized deduction choices, while others do not. Personal exemptions. Many states have dropped personal exemptions since the 2017 federal tax reform, but some still offer them. These exemptions can directly reduce the amount of income subject to tax. Credits. You can get credits for many things, including education, low-income housing, and renewable energy. Credits are particularly valuable as they reduce tax owed dollar for dollar. 4. Tax filing and compliance filing requirements. Residents, part-time residents, and those who earn income in these states may need to file state tax returns. Non-residents who earn state-sourced income must also typically file. Filing deadlines. They usually align with the federal tax deadline, April 15th. But there can be exceptions, and you can often get extensions. Economic and social implications. State income tax. Type and rate matter. They can greatly affect a state's economy and its residents' well-being. Progressive tax systems can help with income inequality, but they may also cause higher earners to move to lower tax states. Flat rates are simple and can attract business, but they might unfairly burden lower-income people. Sales tax. Stores charge it when you buy things. The rate varies by state. Sometimes there are extra local taxes. 1. General sales tax. Most states and some local governments impose a sales tax. It applies to the sale of goods and services. Here are some details. Varying rates. Each state sets its own sales tax rate. For example, California has a high base state rate, but rates can vary a lot from state to state. 5 states do not have any state sales tax. They are Alaska, Delaware, Montana, New Hampshire, and Oregon. Applied at point of sale, the retailer collects sales tax at the time of the final sale to the consumer. The business bears the burden of managing the collection and remittance of the tax. 2. Local sales taxes. In addition to state sales tax, many local jurisdictions impose their own sales taxes. These taxes can greatly affect the total tax rate. Additional local taxes. They can add extra sales taxes. They add them to the state's rate. For example, New York City's total sales tax rate includes the state sales tax. It also has a city sales tax. It also has a surcharge for the Metropolitan Commuter Transportation District. Variation within states. This means two cities in the same state can have different sales tax rates. The difference depends on local policies. For instance, in Colorado, cities can set their own sales tax rate. Total rates can vary widely, even between neighboring cities. 3. Exemptions. Sales tax applies to most goods and some services, but states often exempt essential goods and services to lower the tax burden. Common exemptions. Many states exempt groceries, drugs, and sometimes clothing from sales tax. They do this to reduce the cost burden on consumers for essential items. Selective services. Not all services are taxable. Doctors and lawyers are often exempt. However, the tax authorities might tax furniture delivery and installation. Exemption certificates. Businesses buy goods tax-free with exemption certificates. They must collect taxes from customers when they sell the goods. 4. Economic and social implications. The structure of sales tax has several implications. Regressivity. Sales taxes are generally considered regressive. They take a larger percentage of income from the poor. It is more than they take from the rich. This is because they apply uniformly, regardless of the purchaser's income. Border effects. Different sales tax rates create incentives for consumers. They may shop in areas with lower tax rates. This affects local businesses and tax revenues. This is especially true in border areas between states with different rates. 5. Compliance and challenges. Businesses must navigate complex sales tax laws. This is especially true if they sell goods or services in many states. Collection and remittance. Retailers must collect the right sales tax. They must then give it to the right tax authority. This can be hard for online retailers. They must understand and follow tax laws in many places. Tax software and services. Many businesses use specialized tax software. It handles the complexities of tax calculation. It also handles tax collection and payment. These are for sales taxes in different places. Property tax. Homeowners pay it based on property value. It mainly funds local services, like schools and police. 1. Primary funding for local services. Property taxes are a key revenue source for local governments. These include counties, cities, school districts, and special districts. Here are the specifics. Local services. The taxes fund services. These include public schools, local police, fire departments, libraries, parks, and roads. Local control. Local governments rely on property taxes for funding. This gives them fiscal autonomy. It lets communities meet their needs. They can do this without relying too much on state or federal funding. 2. Assessment and basis property taxes are ad valorem taxes. The basis for these taxes is the value of the property, including the land and any structure. Assessment process. Local government assessors evaluate property values regularly. They do so every year or every few years. They base their evaluations on market condition. They also consider any improvements or changes to the property. Fair market value. Assessments aim to show fair property value. Values can change with the real estate market. Changes in assessed value often cause changes in tax bills, not just changes in tax rates. Tax rates and calculation. Local taxing authority sets its tax rate. The rate is often expressed as a millage rate, amount per $1,000 of property value. The assessed value of the property applies to ES millage rates. Mill represents 1/10 of a cent, $0.001. A mix of local budget rules and voter approval often sets tax rates. Calculation of tax bill. Calculate the tax bill, multiply the property's assessed value by them, then divide the result by 1,000. For instance, if the millage rate is 20 mills and the property is worth $200,000, the tax would be $4,000. 4. Homestead exemptions. Many states provide homestead exemptions. They reduce the taxable value of homeowners' main homes. This offers relief to homeowners. Exemption value. Homestead. Exemptions can be a flat dollar amount or a percentage of the home's value. For example, a state might exempt the first $50,000 of a home's assessed value from all property taxes. Eligibility. Typically, only residents who own and occupy their homes can get these exemptions. They must use the home as their primary residence. Additional benefits may also be available for seniors, veterans, or disabled homeowners. 5. Economic and social impact. The reliance on property taxes has significant implications. Stability versus volatility. Property taxes provide stable revenue. Sales and income taxes are more sensitive to economic cycles. However, during real estate downturns, property tax revenues can also suffer. Equity concerns, property values determine property. They can be regressive, hurting those with lower incomes or misaligned home value. 6. Challenges in administration. Administering property taxes is hard. It includes ensuring fair assessment. It also involves managing appeals from property owners. And it means integrating exemptions and relief programs, well, tax filing and collection. The IRS is a federal agency. It collects taxes and enforces tax. Taxpayers must file an annual tax. They use it to report their income and calculate their tax. They can deduct certain expenses. These include charitable contributions and mortgage interest. They reduce the amount of taxable income. You can make payments through withholdings from paychecks, or you can use estimated tax pay. You can also use payments made when filing a return. The U.S. tax system uses both pay-as-you-go and self-assessment principle. Taxpayers pay taxes as they earn or receive income. They must self-report all income and deductions truthfully. Before I say goodbye, I wanted to remind you of a few things. If you enjoyed this podcast, be sure to subscribe. Also, comment, like, and share it with your loved one. And turn on notifications. I love having you with me. I want to keep exploring the world of world affairs, breaking news, and the complex web of global dynamics. Also, all the information I provide in this podcast is for general info only. I do so with good intentions.